It was a really tough day out there today, and, man, it was pretty ugly for some stocks, and the bloodbath in the NVIDIA stock continues, as well as other stocks. Looks like Amazon did not make it through the day without plenty of pain in that stock. Broadcom is just getting shellacked. Tesla continues to sell off. Google continues to sell off. It was just a really, really tough day. And really it's kind of been forming because it's been so good for so long, right? Over 2 years of just upward appreciation and you know, high expensive stock prices, especially euphoric prices. The stocks that are just too much enthusiasm, too much, oh, it can never come down and attitude. And really they can. They really can. When a company like NVIDIA is a real company. They are brilliant people that are creating the world's best GPUs. Nobody doubts that. They are excellent at what they do. Just their stock price got too high. So I actually put NVIDIA in a class of their own, which is just the stock's too high if the company's great. But I've seen some other stocks where the businesses are okay. They're just caught up in this AI fantasy of, oh, AI is going to be so valuable. Really? Some utility stocks just blow my mind how investors are willing to pay the prices they're paying. And some other technology stocks that are just way too high. And the process of correcting those prices, the market doesn't do an orderly sell off. It just starts selling off like it did today. And it's pretty ugly. It's painful. It's all those things. And if we stay in this mode where these stocks are going to sell off for a long period of time, we may end up in situations where it's going to be great to buy great companies, make lots of money over time. But if it's your intent to make money, this month, the type of investing that I do is not your cup of tea. I want to buy great companies and make great money every year. I want to see my portfolio get better and stronger every year. But I'm not a trader. I have nothing against traders. I think what they do is what they do. It's just not what I do. I'd rather buy a great business and hold it for a while. And we're going to get that opportunity if we continue to see red heat maps like this for the next 3 to 6 months. You better believe it's going to be awesome for investors. We will figure out how to get more capital so we can put into these stocks because the stocks will look great. Valuing stocks based on their intrinsic value, the free cash flows we expect out of those companies, valuing those companies based on that particular metric is the way that I invest. And that's what my channel is all about, is really trying to capitalize on stocks that are unappreciated, priced incorrectly, priced at a huge discount that I could buy. And if we continue on this road for a while, I'm going to have plenty to pick, plenty of stocks to find that are discounted. Not too long ago, I was complaining that it was hard to find discounted stocks. If you watch my channel, maybe in the fall period of 2024, it was getting tricky to find good companies that were discounted. So we'll see. We'll see what 2025 has to offer. It's been an interesting year. It's been rotating from one sector to the other. You see that technology obviously has been selling off, but healthcare companies, there's some green up here. These big pharma companies, they saw their stocks go up on a brutally red day. Med device companies went up because these are stable, growing companies, profitable. Consumer staples. Now, this is an example of how people go to safety. I'm not a big investor in staples. I think that you're buying short-term relief, but giving up long-term gains. I'd rather keep the long-term gains, find a different way of getting short-term relief. Same thing with utilities. I don't like utilities. Real estate really stood up tall today. It stood up nice and tall. But all other places, it seemed it was just a really, really tough day. And just, put on your chin strap this week. It may be just as ugly as it was today for the rest of the week. I don't see any big story that's going to help us. I know that we had one story, which was that we had the tariffs are going to go in place with Mexico and Canada. We have some international tension, and there's no real positive catalyst like, hey, this one economic thing is going to be better. On our Discord, I think Daryl reported that some of the economic data came in, and it came in a little negative, showing that the economy is not doing great. So the economy is not going to prop up a stocks because the stock market is probably thinking we're probably going into a light recession or just a slow growth period of time for the economy. So that's where we're at. That's where we're at. How can we make the best out of it is, just stay on course, man. Try to find really good businesses that are discounted. They're out there. I'm going to show you some examples on this live stream. They are there, especially in healthcare. So looking at the market a little further, the number one sector is healthcare right now. It's up 8.61%. In the first 2 months of the year. It's doing well. Consumer staples is second, financials is there. So that is interesting. The big caps, the first 9 stocks, the most valuable ones, all went down. Meta and Berkshire out of the top 9 are the only ones in the green for the year to date. And Eli Lilly Healthcare went up nicely today, and it's up 20%. So healthcare is just obviously a place where we could seek good performance in 2025 if things continue where they're going. There's no reason why healthcare couldn't continue to perform. There's a lot of things behind that trend that I think are going to continue. So that is interesting. I don't think we had any big earnings today. I think we had Okta announced. We'll take a peek at that. It's a software company. It's kind of a sleepy software company. We'll take a look at that. GitLab. Let me take a look at that. And we'll take a look at that a little later. All right. Let me say hello to some attendees here. So it looks like Daryl, you're on. Thanks for joining. Android PC, good to see you. Shadow Guy, my buddy Shadow Guy. So the company you want to look at is GFL. Is that the Global Football League like the NFL? Or is that a stock? That's probably a stock. Sabir, number 2. How are you, sir? Good to see you. Jay Zev, good to see you. Thanks for joining. Rotel and Cheese. You love red days. You deploy cash. All right. Way to be tough-minded. Carlos, healthy pullback. We all want it. I'm with you, buddy. It's just we'll see how deep we're going to get in on this one. And I'm always careful not to welcome too much pain and suffering because, man, if we're in this thing for 6 months and we're down, 20, 30% on the S&P, that won't be fun. So we'll see how deep it's going to go, how far it's going to go. We'll see. Joey, how you doing, man? You weren't home all day. What happened? Stock sold off, Joey. Mike, the dividend investor guy. Joey, all right. Cool. Super microcomputer. Glad to talk about it. We could talk about that. I think there's some lessons to be learned there. Daryl, we also need to keep in mind that 5% drawdown can happen several times during any given year. I agree. It's just, I'm seeing that, man, these drawdowns, they've got meaning behind them. When you have Nvidia report awesome earnings and then it sells off like it's sold off, there's something there. I just think it's gonna take longer. I'd be surprised if the S&P doesn't have a correction, which is down 10% out of this period of time. I'd be surprised. I think we're in this for a little while. Rotel and cheese, European stocks have been kicking kicking butt. Yeah. I started buying into a German ETF. Shadow Guys in Europe. He's been on looking at that. BAE Systems, the aerospace and defense companies, Thales. Take a look at Thales, and I'll tell you a personal story, by the way. I actually traveled to France at the time. This is a long time ago, like 20 years ago. I got a paid trip to Europe because a division of Thales was interested in improving their software systems. And they sent me and a team of people for a week to France. And it was pretty cool. Pretty cool. I believe Thales is headquartered in France. All right, Joey. So you got a comment for Daryl. Cool. Rotel and cheese. You want to look at Rolls Royce. Rolls Royce is in Europe. I believe the Rolls Royce we're going to look at does airplane engines now, right? Because the Rolls Royce car, I believe they sold that business to one of the big automobile companies like Volkswagen. Retired guy, Grab. Man, I've heard so much about Grab. Let's take a peek. It's like the second coming of Uber. Talmiz 100. Victor, I disagree. Disagree with you about healthcare stocks. I think they are very vulnerable. And the fact that Kennedy is not a friend of Big Pharma is a very dangerous for that sector. You make a good point. So I take your point. I think your point's a good one. I have a lot of other points to make, but I think as we communicate with one another, please keep comments like this coming, because sometimes, like the case here, I agree with your comment that Kennedy is not a friend of pharma, but there's a lot of other factors that are, I think, helping healthcare. But again, let's have a productive Discord. Keep comments like that coming. I will try to convey how I see things as honestly as I can, knowing that you guys will probably take it the right way. Even if we disagree, I think it could be really productive. Sabir 2, DHT. Take a look at DHT. All right, so let's get going. Let's check out some companies. This is where the rubber hits the road. And we're going to look at GFL. GFL Environmental offers non-hazardous solid waste management, environmental services in Canada and the United States. It offers solid waste management, liquid waste management, soil remediation services, including collection, transportation, transfer, recycling, and disposal services for municipal, residential, commercial, and industrial customers. Where are these guys located? So they're in Canada. And they're in Ontario. I don't know where that city is. I'm going to guess it's near Toronto. That's their big city. So market cap, 18.44 billion in US dollars. Okay. And revenue is 5.46. Forward P is a little high, 52. Strong buy. It's a little discounted. So for the 1 year, it's up 30%. 5 year, up 193%. Man, that's a good thing. And what did it do today? It went up 3%. Man, this thing, every angle, this stock looks good. Looks great. Okay, good. They are growing, and their growth is slowing down. You see how they went from very high growth. They may have been acquiring businesses, and then they are slowing down, which I find surprising that the stock continues to move the way it's moving if the growth is really slowing. This is single digit, right? Maybe 5% grower. Let's take a look at their profitability. So their gross margins, not very good. 19% profit margins. They actually lost a little money. So they're losing money. And they do have free cash flow in the trailing 12 months, in the last 12 months. And they're 18 billion, huh? I don't know how we're getting this valuation. I mean, the very best I could do is like 6 billion based on that cash flow. And they have $7.3 billion of debt. So, yeah, this one is not lining up for me. I can maybe value the company 5-6 billion, and they have 7 billion of debt, which is really hard to get over. So this one's a total pass for me. I have no idea what investors are seeing that is making them really like this business. It's slow. I can understand when they were growing really fast that maybe the stock worked really well. But they have debt. Maybe they got that debt because they acquired some businesses, and they're not creating a lot of cash. So I can't get to the valuation based on free cash flows. Analysts, 9 of them cover the stock. They think it's discounted by about 6.5%. And their future earnings here for 2025, $1.45. I guess they're going to turn a profit, and investors are excited about that. And based on that profit, they're going to have a very high PE. Paying a PE of 46 for a company that's growing at 5% doesn't seem right to me. And especially a company that's got 19% gross margins. I mean, you can go find a tech company or a pharmaceutical biotech company that has margins upwards of 80%, growing at 20%, and their forward PE is 15 to 25. So why am I paying 46 for an industrial company that is a waste management company? So I don't like this one here. It's just not the right investment for me. I cannot get close to the valuation that it currently has. So thanks for asking about that, Shadow Guy. All right, so let me take a look and move on to Zeta Global. So Zeta Global operates an omni-channel, data-driven cloud platform that provides enterprises with consumer intelligence and marketing automation software in the United States. Okay. They are located in New York City. Now, this space has been doing great. AppLovin's in this space and a couple of others, and AppLovin's been screaming up in price. This is a $4 billion market cap business. It's up 60% in the 1 year. It's been selling off year to date. And it wasn't doing anything for a while. And this is the same thing with AppLovin, by the way. For some reason, AppLovin and a couple others just started to really scream up in the middle of 2024. So this guy here looks like it's had a pretty strong pullback. Look at this volatility. It is a small cap. So you're paying 4 times revenue because you're looking at a market cap of $4 billion, and they've got about $1 billion of revenue. Forward P is 22.31. It is a strong buy and it's heavily discounted according to analysts, and they're basing that on earnings per share. It does have very nice growth, 49%. Very nice, very nice. It's $1 billion revenue company. Pretty good size, 38%. Look at that. That looks good. Gross margins of 60%. They do produce free cash flow. Based on their growth rate, and let me check out their debt. So they have really no debt. They have more cash than debt. So that is fine. This business is worth $3 to $4 billion. If I take their free cash flow, multiply it times 30 to 40, because they're growing so darn fast, they have good margins. I think those margins can expand once they get larger. But if you take 108, multiply it times 30, we're going to get about 3 billion. And maybe you say, well, I really like the business. I'll pay 40 times free cash flow. I get to 4 billion. And these guys are at 4 billion. So they're on the upper end of that valuation. So this would be a nice watch stock, but I wouldn't want to buy it because it's priced, free cash flow. It's priced fairly. I don't want to pay fair price right now, especially with a declining market the way it's been declining. So this might be a good watch stock, but it needs to come down maybe 25 to 40% in stock price. Then it'd be a really good looking stock. Nice discount on it. It's growing really well. It's in a good space, which is the whole omni-channel software to help businesses market online. All that makes sense to me, but the stock price is just a little too expensive. It's up 60% over the 1 year. So, maybe a year ago it looked great, but of course, we can't transact 12 months in the past. We can only transact today. So it's a good one. Nice little interesting company. And right now it's fairly priced. The analysts that cover this, 13 of them, there's some that are very optimistic. They believe it's a $45 stock. On average, they believe it's a $36 stock. And the most pessimistic, the bear in the crowd, is still at $18 a share. So they're supposed to keep growing. They're going to get a little bigger. That growth is going to be a little harder because the number is bigger. But the growth is expected to continue. That looks really good. So good little company to take a look at, but I'm not ready to buy. I'm not getting a big enough discount. And these small caps right now are getting really sold off. One thing I didn't look at, and I'll look at it now, I think it's worth doing, is when you look at the NASDAQ, it is down about 8.5%. So we're at 1.5 from a correction on the NASDAQ. When we look at the Russell, it's doing the worst. We've got the Russell's already at 9.24. So just a little more and the Russell's in correction territory. And that's normal. When things get risky, things get fearful, the Russell sells off. Small caps sell off. Investors want to be in a name they recognize. The S&P is down 4.79. So it's on its way. And a comment I made earlier is I'm expecting the S&P is going to sell off by 10% or more during this period of time. Might take us a month, 2 months to get there, but we'll see. We'll see. I think I'm reading this correction as a pretty good one. The market's been pretty darn angry. And it didn't care that there was good earnings out of NVIDIA. It doesn't care that, some positive things like President Trump announced that Bitcoin, the US government's going to have a reserve of some sort. Well, that was supposed to really help crypto, which it did. It opened up higher, but then it sold off along with crypto related stocks. So that couldn't help it. And then the Dow's doing the best out of the exchanges. Then we'll move back to stocks. This one's down about 3.77. So the Dow is holding it together best. All right. So that was Zeta. So what's going on with Okta? Okta announced their earnings. $15 billion company. Forward P is 29.7. And after hours, it's up 15%. Wow, they must have put up a really nice number. These software companies are kind of being forgotten. This one's growing nicely. And am I seeing the latest? No, I'm not seeing the latest numbers. This is a quarter behind. But it has good free cash flow. I don't think tremendous free cash flow, but it has free cash flow. Gross margins of 76%. And it sounds like they announced really good earnings. I'm not seeing it here, but the stock's doing really well in after hours. So go Okta. And I think the software space offers some really good companies that are at a discount. So keep your eyes out for good software companies. All right, let's get back on the list. And we'll take a look at Super Microcomputer. Man, this is just it's bad. So Super Microcomputer is a stock that I've done videos on for, let's call it a year and a half, 2 years. And this is when it goes. So when a stock goes parabolic like this, you see the chart, just goes straight up. It's like a cliff. Like if you've been to Yosemite in California, there's these granite walls, El Capitan. That's what it looks like. It looks like a sheer cliff made out of granite. Well, this is unsustainable. You're either going to go down or you're going to keep going up. And at the growth rate that it was going, it'd be worth like 90% of the stock market at some point. Just insane. So instead, it became a falling knife and it collapsed. I started shorting the stock like around here. I made 52%. I got out. All right, cool. We're done. But investors thought, well, it's probably going to do more of this at some point. And it kind of did right here. But, it comes with a lot of risk. Investors that took this ride are so happy, but they needed to know when to get off. And I'm sure some people did, because after that, it just got crushed, 40% down. And I don't think this stock is just going to continue to get crushed. This is a hardware company. Hardware companies don't make a lot of money. They make very little margins. Gross margin, 12.44%. Whereas when you go to a company like NVIDIA, NVIDIA owns the IP of their products, the intellectual property, the patent. And they say, I'm going to make gross margins of 75%. I'm going to make a lot more money. Where our friends at Supermicro are like, we just assemble computers. We're really good at it. They don't make anywhere near the margins of NVIDIA. So these guys are kind of associated with NVIDIA, but I think I used an analogy that I liked last week, which was if you had a football team and you have the quarterback making $50 million, and then you have the equipment manager making $60,000 a year, they're part of the same team. They go to the same games. They're both doing their occupation to the best of their ability. But the quarterback makes $50 million and the equipment manager makes $60,000. This is more of an equipment manager. They're just barely getting by on their margins. So it's not a desirable business. It's a $21.4 billion market cap. Revenue is about 20 million. Forward P is 12. If you look at earnings per share, this is where earnings per share is confusing and risky. Charlie Munger hated earnings per share. It makes some analysts think, oh, it's a $130 stock. No, it isn't. This is all somewhat funny money. And I would say that NVIDIA already got themselves, Super Microcomputer already got themselves in so much trouble that their auditor resigned fired them as a client. So I don't think auditors are all that like comfortable with the way they do their accounting. So I wouldn't trust earnings per share. I don't depend on it for valuations. I'd rather go to a free cash flow. Earnings per share is an influence, but the primary value is free cash flow. Super Micro is just it's a basket of problems. It's a distraction. And we're going to start seeing stocks that are really discounted nicely. I'd rather preserve my capital and get ready to buy some great businesses that I want to own for the next 5 years. I don't want to own Super Micro for 5 minutes. So I wouldn't touch it. I shorted it. I made money on it. I'm done. I don't want to touch it. It's just be a distraction. When I short stocks, sometimes I just want to like confirm that I'm seeing the right thing. So I put some money on it. Right. And it was the case on Super Micro. I analyzed the company and I was, I guess, vindicated or proven to be correct on it. I'm done. That was a little pet project. I'm done. I shouldn't be in it. And I would be very curious to see if an investor had a thesis on Super Micro, like a real thesis, like analysis. This is where I see their projections to be, their growth. This is where they're going to make money and so forth. And I'd really love to see that, but it shouldn't be, hey, I'm going to buy because I think I want to ride up a particular short trend of a lot of retail investors wanting to pump up the stock. That's somebody else's investing game, not mine. So that's Super Micro, just a lot of pain and suffering in that stock. It's not going to go away. I think it's just going to be a tough time for that business. So this is BAE Systems. This, I believe, is going to be a aerospace and defense company. So we've got, I think I'm going to go with the over-the-counter. Wow, look at that. Up 17% today. It was trading at the beginning of the year at $14 a share, and it's up to 21. Yeah, year to date, it's up 47%. So there's obviously a conflict in Ukraine. I believe Ukraine is now lining up to get more support from Europe, and this company is probably going to benefit from that new trend. These guys are in the United Kingdom. They're an aerospace company, big employee count. 61 billion in market cap. This is in US dollars. 33 billion in revenue. PE current year is 24.9. They are growing. Growth is 14%. Now, I'm expecting it's going to be low margins. Aerospace and defense companies have lower margins. Yep, 8%. Wait, it used to be 65, 66, 63. Wow. That's a big, big drop. But I expected it to be low because aerospace and defense companies tend to have lower margins. That's interesting that I'm seeing big numbers in the previous years. Free cash flow looks good. I'm not overly excited about aerospace and defense. I think their fundamentals aren't great. This is worth like 30 billion to me, maybe 40, unless there's too much debt. Always with aerospace and defense, they tend to carry debt, so be careful. These guys are carrying $8.6 billion of debt. So these guys are worth like 30 billion to me. And I'm not overly excited about aerospace and defense. I know that right now there's a big rally in them, but that could be gone in a month. I don't know. I hope that there is no war, because then that means a lot of people are going to be killed. A lot of people are going to be injured. Hopefully, fingers crossed that we don't end up in some war. But that's right now. These stocks are working. They are working big time. Look at that. That's BAE. Thales. So as mentioned, I had the opportunity to travel to one of their subsidiaries, and when I worked for, I guess, is when I had Thales as a client. They were headquartered in France. Yeah, France. These guys are like old school, man. 1893 aerospace. Whoo. That's going back in time, man. $48 billion market cap, revenue 20 billion. PE is 32. It's a little high. The 1 year, 70%. Look at this rise. And all in 2025. Wow, those aerospace companies really took off in Europe. Well, there you have it. These stocks here, they probably, all the stock appreciation is priced into the stock now. It's going to be hard to find any of these that are based on my investing recipe for success. It's going to be hard to find these that are discounted and therefore making them a really good investment. So this one's a 6.5% grower, but if they get more business from Ukraine, maybe that increases a bit. Free cash flow is a little low. It was lower than BAE. And the gross margin. See, this is what I was talking about earlier. This is what I expect out of aerospace. This is kind of low gross margins and then profit margins of 7%. Yeah, this one isn't worth a whole lot for me, man. It's like a $15, $20 billion company, and it just has seen a really nice appreciation. Good for all these investors that own the stock, but it's not a good investment for me. I think the price of the stock has already got everything baked into it that is positive that could happen for the stock. There's not much more. Rolls-Royce, these engine companies for airplanes, they've been doing great. And wow, 1 year, 114%. Year to date, 43%. 5 year. See how we had COVID and these things sold off because we didn't need that many airplanes. People weren't traveling, but then people started to travel and airlines had to recondition planes. They had to order new planes, and this stock really started to work. This is an industrial, and I looked at this stock maybe a couple years ago, and it just seemed a little expensive then. Well, I was wrong. I should have bought it. But, hindsight's 2020. I probably looked at this stock like around here. It just looked like, man, is this thing going to keep growing? And it obviously did. Hindsight's 2020. $83.4 billion market cap. PE looks 26. It has this really nice rise in in 2025. And that's after having a stupendous year. So this one's probably priced a little bit high. Revenue is good at 14.7. Free cash flow is good at 3.2 billion. Gross margins, here they are. So that's what I was talking about earlier. I just don't get excited about these gross margins because they're kind of small, kind of low. But their free cash flow rate's really good. So that's one good thing about them. They had good growth. So maybe this is a $40 to $50 billion market cap company, but they're way up there at 83 billion. So this is a pass for me. This is somebody else's investment. And a lot of the stock has really been priced up. So all the good news is priced into the stock. So that is Rolls-Royce. Most definitely the aerospace and defense space in Europe is really rallying. Interesting. I'm happy for the investors in those stocks. They made some money. All right. I heard a ton about Grab, and Grab is a combination company. Let me take a sip of water and then we'll get back into it. So if I'm not mistaken, so Grab does ride sharing, food delivery, kind of like that combination of things, similar to Uber. And Uber, I believe, owns 20% of Grab, by the way. And they're located in Asia. Singapore is the country that they're headquartered, and they operate in Asia, in different countries within Asia. Market cap's 19.23 billion. It's worked for the 1 year. It really sold off back here. And a lot of stocks sold off in 22. This one never bounced back up until recently. Year to date, it's a little flat. So their revenue is 2.8 billion. So you're paying about 7 times revenue for the company. Forward P is 69, a little bit high. Their growth is good, but not like exciting good, right? 17%. It's not anything all that exciting. I mean, you want to see exciting. Let's talk about, let's talk about Uber. They're massive and they're growing nicely. So they have a big number. They're growing at 18%. They grow like multiples of Grab. They're growing less and they're a tiny company. Uber grows more than that in a quarter. So I've heard a lot about Grab, like, oh man, these guys are going to be a threat to Uber and stuff. Well, doesn't look like a threat at this point. So 3 billion in revenue. Free cash flow 775. Okay, it's good that they produce free cash flow. At their growth rate, maybe this business is worth 2.4 billion or so net of debt. Their gross margins are okay. See how they're getting bigger as they get bigger. They're not making money yet, but at some point they will. So do they have debt? So they have a lot more cash than they do debt. That's very good. 5 billion in cash. Okay. I think investors are buying into Grab because they understand the story. It makes sense. The fundamentals don't price the stock at 19 billion. The fundamentals for me, based on free cash flow, this is a 10 to 15 billion dollar market cap company. So it's priced a little too high. And I think people are buying into it because they like the story. Hey, this is going to be ride hailing delivery in Asia. Totally makes sense. I have a lot of shares of Uber. I got a winner. I don't need to leave this stock. They keep growing. They keep getting stronger, more powerful. They own 20% of Grab. I already own some of Grab because I own Uber. So I just keep buying Uber shares. No shame in that. Up 23%. It's been misunderstood. Market's been selling it off. And I say, thank you, market. I'll take that discount. Are you going to give me another discount? Thank you, market. I'll take that discount. Thank you very much. I'm up nicely on Uber. And that is a long-term hold for me. So I'm good with Uber. I don't need to buy Grab. It didn't look all that convincing, impressive. Grab just looks like a little company and they're doing okay. All right, so DHT. DHT Holdings, through its subs, owns, operates crude oil tankers, primarily in Monaco, Singapore, and Norway. Okay, so this is a shipping company. 1 year, they're down a bit. 5 year, they're up nicely. They pay a 9% dividend. These shipping stocks tend to pay high dividends, and they don't get valued up to their, what I would say is intrinsic value based on free cash flows. They're just a shipping stock. They're so cyclical. They're so, they'll have like a year or two where there's just a boom and then shipping rates fall. And then they have very, very bad years. So that's why investors don't fall in love with shipping companies. This is a $1.67 billion market cap company, 571 million in revenue. Forward P 8.86, strong buy with a 31% discount. And their free cash flow, 200 million. Looks good. Good margins. Do they have debt? They have $331 million of debt. So this stock's actually fairly priced. I would have said it's a $2 billion stock. You subtract that 300 million in debt and you get to 1.7 billion. So it's a fairly priced stock. It's a shipping stock. Instead of buying this one, I'd rather buy Zim. I think Zim is discounted based on their free cash flows. I actually have a buy order on Zim. I'm just trying to get a really good price on Zim. Let's take a peek at Zim. See if I'm getting closer to my strike price. See, I got a buy order on Zim, just a hair under $17 a share. I'm just waiting like a tiger in the tall grass, ready to pounce. And when it gets there, this thing comes down, goes up, comes down, goes up. It just keeps doing that. So I thought, you know what? I'll buy when it starts getting closer to 16. And I think it's a good buy for me. So I like Zim. I think it's priced much better. I think it gives you a better cushion between its intrinsic value and where the stock is being priced. So that is DHT. Good luck with that. All right, let's catch up on some comments here. We talked about Grab, DHT, Talmiz 100. I say it with all the respect in your investment style and how you value your opinion. Yeah, hey man, I want you to keep bringing it, all right, buddy? You keep bringing comments like this, and everybody do the same, because that is a factual comment that Kennedy is not a friend of pharma. So we're not going to argue. We're just going to compare points of view. And I think we get out of it being more informed. All right, Pfizer. Let's talk about Pfizer, man. I think Pfizer is going to do good this year. FLNC. Yeah, Omar, man. We already did Zeta. You'll have to see the recording. Joey, can I join the Discord? Yeah, definitely. Send me a message. You can send it to me. Just go to the YouTube channel. You found the live stream. Shoot me a note. I will give you an invite link. Carlos, yeah, there's a Discord. Ditto. If you want to be a part of it, reach out to me. ARM. Okay, let's talk about ARM. That would be an interesting one. Those guys are being bid up. See what happens. Mike, the dividend investor guy. GCT came out. It's sold off. Oh, man. All right. GCT, Giga Cloud. These guys are trying to do accelerated computing. They were a miner, but they're trying to sell their capacity to companies that are building AI, large language models. Oh, no, I got the wrong company. These guys do kind of like the logistics for e-commerce. Scratch everything I said. I had them confused with somebody else. So Giga Cloud provides end-to-end B2B commerce solutions for large parcel merchandise. So big stuff, people buy it online. These guys do the fulfillment. And it's down 17%. Holy smokes. What happened, man? These guys are tiny. That's part of it. When you have these small businesses, you know, it doesn't take much to scare away investors, especially on a day like this where you had a huge sell-off. So let's see what they announced. So record total revenues in 2024 reached more than 1 billion. So they had, for the fourth quarter, they grew at 21%. They were profitable. Gross margins were 22%. Their margins did drop from 28.5 to 22. Maybe investors did not like that. Okay. Net income was okay. Cash and cash equivalents, 303 million. And they increased it by 64%. Okay. So revenue is 1.1 billion. Great. And they increased by 65%. So the fourth quarter was a slower growth rate at 20%, and then 65% because they probably grew really fast earlier in the year. Okay. So the company expects total revenues to be between 250 and 265 million in the first quarter. Okay. And if we look at their first quarter of this year, 250, so zero growth. I think that's what the market's really having a heart attack over. You were 251 and you're saying that you're going to be 250 to 265. So best case scenario, they're going to be like what is that, about 6% grower? Best case. Worst case is like flat or maybe -1. So the market was probably thinking, okay, what's going on? And this kind of aligns with what I'm seeing in the economy. Things are slowing down. I think consumers, especially consumers that have the higher incomes, are saving their money because they're seeing that the economy is not doing as great. This business is going to rebuy shares, but I think some of the excitement is kind of lost or investors are not feeling excited. They're not going to grow very well first quarter. We saw that their margin did contract. That's not good. So I think that combination is leading to the sell-off. It sold off by 16.43%. Now, this is a discounted stock. When you look at their cash on the balance sheet was 300 million and you're paying 655 million for the company. So you're really only paying 355 because you have 300 million of cash on the balance sheet, if I read that correctly, right? Cash and cash equivalents, 300 million. So you're really paying 355 for the business. So if you're paying that low of a price overall for all the shares, how much cash flow are you dealing with? So they do 142 million in free cash. So very quickly in 3 years, the company produced enough cash to match the market cap of the company. So this is highly discounted business. I follow this stock and I just, they're so small that I'm a little careful not to buy too fast. Right now I'm not in the stock, but this is where I value the company and I discount them with a 15% discount rate. I'm trying to project their cash flows forward, discount them to today's value using a 15% discount rate. So my rate of return is 15%. Even with that, 51% discount. So this is a highly discounted stock, but when can you catch it at the right time? When will they start growing again? I think on a stock like that, I'd want to know that the economy is on good footing for large purchases because they're delivering big things. Those big things probably cost a lot of money. So I don't want to go into a bad economy and invest in the company. I'd rather be in a good economy and I see that, hey, they're going to have plenty of product to deliver. Their revenues are going to go up nicely. And maybe what I'm sensing in the economy showing up in their guidance, because their guidance is that they're not going to grow very well in the first quarter. So that is GCT. It's unfortunate that it's selling off, but I'm not ready to jump into this stock. I want to see that the economy is in a better place. This stock is heavily discounted. And at some point, if they get larger, it's just going to be really hard to ignore. Look at this PE, 4.6. Analysts think it's discounted by 220%. Wow. Incredible. Trader Prad. What's up, buddy? Did you make a ton of money on the collapse of NVIDIA? I hope you did, buddy. I hope you make a lot of money on that. So that's GCT, man. They are having a bad night. They're here in Los Angeles, the Los Angeles area. And I told myself that I'm not too far from where their headquarters is. I should drive by there and see if I could stop by, do some real in-person research on the company. All right, let's get back into it. Well, let me just read my friend Mike's comment here. Yeah, man. I mean, how low can those shares get? They have cash on the balance sheet. They have the market cap so damn low. It can't go down that much more. I would think. It's just not mathematically that probable. All right. So Joey, you can contact me if you go on any of my videos and you just comment on it. I'll get the comment. Just say, hey, can you give me an invite to the Discord? I'll set you up. Trader Prad, good to see you. Rotel and Cheese on toe, ONTO. It's on the list. So let's talk about Pfizer. This is a stock that I think is going to do well. Today, it didn't do all that bad. On a day when Nvidia went down 8 or 9%, however much it went down, this is not bad. Not bad. This is like, I'll take this. And the stock is misunderstood. Just the market doesn't know what to do with it, but I do. When I'm seeing quarterly growth really stand up on big numbers, these are big numbers. I'm really excited. I really like what I'm seeing. These guys reloaded and bought some companies that had new products that were going through FDA approval, and now they're in the commercial phase. They're going to grow and they're going to stay growing. Look at this free cash flow. Almost 10 billion in free cash. Fresh cash. My favorite part, this is my favorite line right there. Free cash. So that looks good. Now they're growing nicely, right? 30%, real nice. 10 billion in free cash flow. And they're only $150 billion market cap. So I think when everything comes together and they have a full year with the new business and they're showing that, hey, we're growing at 25% and that 10 billion turns into 15, 20 billion of free cash, the market's going to be like, hey, this is a $400 billion market cap company. That's what I really expect out of this company. So that's where I think that the company's headed. And I have a good position in Pfizer. As soon as I see the company, the stock market begin to rally behind this stock, I'm going to buy more shares. I bought more shares today. I've been buying into healthcare as quickly as I can. I'm buying across like 6 different stocks, and Pfizer was one of them. But this one here, man, if I see the stock move and start a trajectory upward, I'm just going to start throwing capital at it and trying to catch that rise. So that is Pfizer. I like where they're headed. I like what they're going to do. FLNC, that is Fluence Energy. So through its subs, it provides energy storage optimization software for renewables and storage applications in the US. Interesting. They are located in Arlington, Virginia. Very interesting. They're small cap, $942 million. They're $2.5 billion in revenue. Forward P is 12. Why am I seeing really good ratios here? These look really good. Big, massive discount. Down 66%. Okay. Growth looks okay. Okay, this is where we got problems here. So the Q1 was a collapse. So you see this quarter went down 48%. Wow, what happened? Why did the revenue collapse? This is a giant red flag. You got to explain this. Like, what happened? Is this going to be a trend, or is it like, what happened? How can, like, this is like CrowdStrike. Oops, we didn't quality control the software. We caused the biggest outage in the history of the software industry. Oops. It's like, no, guys, you can't do that. You got to run a business like professionals. So this is 48 down. Got to explain it. Like, what happened? Why? And this just happened right at the end of December. So that can't proceed without an explanation here. And there's an investigation going on. Oh man, it is not looking good. Not looking good at all. Year to date's down 67%. Man, that is horrible. I feel bad for their employees. So you got some investigative journalism due on this one. Whoever asked about this one, you got to figure out, was that a one-time deal? Was it like, hey, they couldn't ship out product because there's a explanation for it? Okay. And it's probably not going to happen again. All right. Give them a quarter or two, make sure that you get more confident behind it. And maybe that's an investable stock. But for now, there's just too much smoke. There's probably a fire somewhere. There's a situation that I don't want to get involved with. Right now, we're seeing stocks really sell off. I'd rather wait for some of these high quality companies. As crazy as this sounds, right? NVIDIA had terrific earnings. Now, from the month of June to now, I've been pretty much short NVIDIA. But now I'm beginning to think the market's out of their minds selling off NVIDIA the way it's been selling off. If it keeps doing that, I'm going to buy some NVIDIA shares. I've done that before. Broadcom, I owned Broadcom, made money on Broadcom, sold my shares, and it just continued to go up. And I'm like, that's irrational. Broadcom's not worth that much. And now they're getting shellacked. Well, I think very highly of NVIDIA. And, rather than trying to chase something like this, which is like, there's a lot of problems here. If the stock market keeps selling off, it makes it really easy on us. There's a lot of businesses here that are awesome businesses. They're just priced really high. Amazon, if you cut the price by 30%, I will buy Amazon shares like you wouldn't believe. If you cut Microsoft by 25%, ditto. Google, I'm already a stockholder and I'm thinking of buying some shares because it's been really beaten down. If it keeps going to maybe another 10%, I will not wait. I'll just start buying shares. Boom, boom, boom. So there's a lot of quality businesses. And if this market keeps selling off, it makes it very easy. I don't have to go looking for long shots. I could just pick very, very known companies that have great businesses and have a lower risk profile with a better rate of return, because I could really expect those companies are going to revert back to their true intrinsic value, and I'm going to make good money. So that one is there. Now let's talk about ARM. ARM came out with a lot of fanfare. Now these guys do. ARM Holdings architects, develops, and licenses central processing unit products and related technologies for semiconductor companies and original equipment manufacturers rely on the development of products. The company is involved in the licensing, marketing, research, and development of microprocessors, systems, intellectual property, graphics processing units, physical IP, and associated systems IP. So traditionally, semiconductor companies like an Intel, they would look at the market and say, okay, great. We're going to make these types of chips, and a variety of industries are going to use those chips in their products. That was old school. That was 40 years ago. Where now you have businesses like Google that say, we're going to design our own chips because we know what we need for the devices. We're like the phones and the servers and all kinds of stuff. So they partner with ARM, and ARM helps them go from, you have a need, a use case, and then you start the design process and development process. So ARM Holdings is that type of company that partners with other businesses. And I think it's a very good idea. It has a big market cap, 127 billion. Revenue is 3.7 billion. Forward PE is 62. Supposed to be discounted at this time. The 1 year, not so good. The 5 year, pretty good. It had a nice trajectory upward. but over the 1 year, it's just kind of been beat up. They did lose a big case against Qualcomm. They were claiming that Qualcomm partnered with ARM, ARM helped Qualcomm, and then Qualcomm started using those chips in what ARM would say is not based on the contract they signed. But a court said, no, ARM, you're wrong. Qualcomm can do what they're doing. So these guys are growing at 25%. Quarterly looks okay. Had a light quarter here. That might be a concern. Maybe that's why the stock's just been kind of underperforming for the last years. They had a very light quarter in Q2, but the most recent quarter looked pretty good. So 25% growth. Free cash flow is $650 million. Gross margins really high. They're not manufacturing anything. They're partnering, and then once they have co-developed something with a company, the designs and so forth, they go to TSM or somebody to manufacture it. So they don't get their hands dirty. They just make lots of margins. Very high margins. So profit margin looks really good. So let's say they're a $1 billion, free cash flow run rate company. These guys are expensive. They're too expensive for my taste, man. I think they're worth 40 billion max, and they're 127 billion. I would not be an investor in ARM. They have $2.4 billion of cash. Yeah, they're priced too high. Their cash flows not even close to it being enough. Their cash flow would have to be around 5 to 7 billion in order for me to pay $127 billion. And because their growth rate's only 25%. So no, this business is priced way too high. This needs to come down. This is probably going to get smashed for a while. 8% had an 8% down day, and it could probably get smashed down to like $50 a share. Whoa, that's a giant drop. But I think that's what the fundamentals are telling me. I don't think ARM is worth anywhere near their current market cap. We shall see. We'll see what the market does. ONTO. Onto engages design, development, manufacturing support of process control tools that performs optical metrology. Company offers lithography systems and process control, analytical systems. It also offers process and yield management solutions, device packaging. Okay, they're in the semiconductor space. All right. Now, not all semiconductors are made equal, right? Let's see what their margins are all about. Gross margin is 52. That's pretty good, but it's not NVIDIA good, but it's pretty good. 6.7 billion. Revenue is about 1 billion. Forward P is 21. Strong buy with a discount. Growth is pretty good in the most recent year and consistent over the last year. Okay, that looks good. All right. Free cash flow is 213. Okay. So this business is worth 4 billion minus debt, and their debt, they don't have any debt. So it's worth closer to 5 billion, and they're at 6.7. So this run up due to the data center build out expectation and the whole AI story has made the stock price really expensive. And now it's coming down. And I would say it's probably going to come down to like $80 a share because the market's going to correct it, bring it back down. It's cash flow cannot sustain a market cap of 6.7 billion. It can sustain maybe 4 to 5 billion, in my opinion. So this one here is not a good stock for me to buy. I think I would lose money, and investors are not having a good time in this stock right now. And it's selling off, sold off today. So semiconductor is really tough right now. Just a lot of things are priced way too high. And I've got very little exposure to semiconductor right now. So thanks for asking about that. All right. So GCT. So Mitch, let's talk about Adobe. And of course, I never offer any financial advice. I never recommend you buy, hold, or sell any stock. The decision is completely yours. But I would share with you my comments on Adobe from the point of view of what I would buy and how I would invest in Adobe. $191 billion business. This is a quality company. This is one of the best software companies really in the industry. And they really dominate the creative arts, creative occupations that Adobe provides tool sets of people to do digital media. And their stock has really not worked for the last 5 years. But I know this business well. I've known of the company for a long time. They just keep growing and growing and making their business bigger and bigger and bigger, making their business more profitable and generating tremendous free cash flow, close to $8 billion of free cash with a very good growth rate. Look at these margins, 89%. Beautiful, beautiful number. So when we got high margins, 8 billion, multiply that times 30, we get to 240 in market cap. Now I've got a full valuation that I'm going to show you after I show you the forecast. Some analysts think it's a $660 stock. Some think it's 445, which isn't bad, 25 analysts. So your low side isn't all that bad and their high side's pretty good. I'm a believer in Adobe. I'm a stockholder in Adobe. And because I think that Adobe is a stock worth having. It's just such a quality company. It's discounted by 26%. And I think the industry, or excuse me, the market's selling it off because, you know, the AI stories are turning into fairy tales now very quickly, and they're vaporizing. Just ask NVIDIA. And one of the AI stories is, well, AI is going to replace Adobe. Now, I've used the AI apps are out there, and I think it's interesting. But no way would I like let AI write a letter for me or create a picture. I've been creating pictures with AI, and it tries, but it doesn't do anywhere as good of a job as a human being. Nowhere near. So who is thinking that AI is going to replace Adobe? And Adobe's bringing out their own AI product themselves. So I think there's a kind of temporary kind of misunderstanding. And they're going to report, I think, next week. And I think they're going to crush their number. And at some point, Adobe is going to revert back to their intrinsic value. It's going to go up 25, 50%. So that's my story on Adobe. I really like Adobe. And their stock did okay today. It held its value, which is saying something. But it hasn't been doing all that great, right? Year to date, 0.89. 1 year, not very good, but these pullbacks are opportunities in my mind. So that's my feeling on Adobe. Good luck with your decision. Till the end. Good to see you. How are you? Rivian, I priced like a week or two ago. Didn't look good. And we got PayPal. So let's talk about Rivian, and then we'll talk about PayPal. So I don't like car businesses. They're just tough, man. It is so tough. And these guys, I mean, they're not down for the year, so I guess that's a victory. But where are they going to make money? $13 billion in market cap. When we look at their financials, let's look at their growth isn't very good. And I think they're guiding that they're not going to grow very well. They have so much competition. Everybody has a cool EV now. And you have businesses that have been around for 100 years that you're trying to compete against. Good luck. Gross margins. They lose money on every single unit that they put out there. Well, who would want a business like that? You produce a product and you spend $100 making the product and you sell it for $75. Man, I would lose my enthusiasm for that business quite quickly. And that's because they don't have scale, but just the car business has very low margins. So it's just not a business that I want to be a part of. No free cash flow. So this is all negative. Will they go bankrupt? Probably not, because Amazon still owns part of them, and Amazon's depending on them to make all the EV vans for them. So they'll probably be around for that reason, but there's nothing else exciting in there. EVs were cool 20 years ago and 15 years ago, I guess. And EV companies were perceived to be, oh man, kind of a marvel, right? It's a car business. No thanks. Give me an Adobe at 89% margins. I'll take that. You can keep the EV business. Rivian's just not a stock I can touch. Now, if I won, I'm not going to buy a Rivian car. We just bought a really nice car, my wife and I. But if I won a Rivian, let's say somehow, right? Like I was given one, I'd keep it. They're cool cars, but I'm not going to buy a car right now. Not another car. We just got one in November. So good luck with that. And I wouldn't touch any EV companies, man. I've worked too hard for my money. I want my money to keep getting expanding. I want my portfolio to keep getting bigger and bigger and bigger. And that's what I want, man. So PayPal, 15% for the 1 year. It's been selling off. Man, it's selling off hard. This is a good stock, man. And this stock here, $69 billion in market cap. At one time, it was a $300 stock. Now it's 70. I think it can get up to $150 to $200 a share. This stock is so discounted. Let me show you how discounted it is. It's discounted by 110%. Their cash flows are so high. The value of a company is the present value of all the cash flows the company is going to produce. Cash goes on the balance sheet. It could be used to buy back shares, acquire other businesses, be returned to the stockholder. And these guys produced tremendous cash. Based on that cash, the business is worth 146% more than its current stock price. EPS, earnings per share, brings the value down a little bit. But overall, this is just a highly discounted stock. And when we look at the PayPal business, are they growing? Yes. Are they profitable? Yes. Absolutely. Gross margins, very good. They're a payment processor. They're not a software company. They're growing around the world. They have the Venmo business. They're into crypto. They have a lot of things going for it. Now, the market, for some reason, started to dislike PayPal and sold them off. So it's an opportunity. It's a business that's misunderstood by the market. They announced on February 4th, they have a new CEO. I think he's doing a good job. PE is nice and low. So I will gladly continue to buy PayPal shares. I already own a big position of PayPal, and I'm okay with that. I like PayPal. Thanks for asking. We're humming along. We are moving. Target. You want to talk a little Target or Target, as some people would say. And my lovely wife went to Target today and she bought some stuff. She asked me if I needed anything from Target, which is why I know that she went to Target. $55 billion in market cap, $107 billion in revenue. This is a retailer. I'm not in love with retailers. I don't like retail. I think it's a tough business. It's down 22%. 5-year, not very good. You got to perform better than that, but that's my opinion. 3.71% dividend. I don't really care about dividends for evaluation, by the way. It's a nice low PE. The business is flat for 1 year, 1 year flat. And I'm trying to get my head around their fiscal year. The fiscal year ends February, and it looks like their February 3rd, 2024 year was a contracting year, and now they're flat. Okay. So it's a slow grower or a flat growth company. Not good. They are producing cash, $4.5 billion of free cash. Margins are what they are for a retailer. This business net of cash is worth $45 billion to me. And the balance sheet shows that they have $16 billion of debt. So it's really worth $30 billion to me. And they're priced at a $55 billion market cap. So no, thank you. I'd rather buy PayPal. I'd rather buy Adobe. I'd rather buy other businesses that just have better momentum, like Rolls Royce. I should have bought Rolls Royce 2 years ago, right? Everybody knows that now. But trying to find the next Rolls Royce that is about to launch. Target's not that business. These guys are so big and they're competing against all these other retailers. No, thank you. They may have a good earnings, maybe pop 5-10%. Good for them, but it's just not a place that's going to build value for me. It's going to make me wealthier over time. It's not going to do those things. So I will pass on Target. All right. So we covered Target. Till the end, how do you feel about space companies? I don't like them. Too risky. Who knows what happens up in space? And it's not something that I can get my head around, like, and really know what's going to happen. I'd rather buy like a business that I know what's happening, like Google Alphabet. We know what's happening, and that's pretty impressive company. That's my investment. Or Meta, or PayPal, or Uber, or Robinhood. Those are my investments. You go off into space, it's like, man, it's expensive, it's risky. You could have a complete loss of an asset that you launch into space. Just so many things can happen that are bad. Joey, PLD. So I think you're a young man, right, Joey? You're 18. So we're going to look at PLD, and then I'm going to leave you with a thought. So Prologis is a real estate investment trust, I believe. Yep. And they're focused on high barrier, high growth markets. I think they do warehousing. Yeah. So logistics facilities. So warehouses. Now these businesses, this one's done okay, 39%. 1 year, down a bit. Okay. And it's $116 billion market cap. REITs, I don't value based on free cash flow. It's not the right way. You look at it from an earnings per share perspective. And according to that, they're priced about fairly. Now I have a 20-year-old son. I have a 24-year-old son. I help them manage their investments. And what I would want for them is I want them in an investment that looks more like this. Okay. How can we find Robinhood or Meta when it was cranking up? Even Meta's looks great, right? Both of those are in both sons' portfolios. Or I should say one son lets me manage his portfolio. The other one, he does it on his own. So this is the rate of return that I want for a young investor. So if a young investor at 18 says, I want to invest in a real estate investment trust, nothing wrong with real estate investment trust. But what are you trying to accomplish? If you're 18 and you're like, I want to wake up when I'm 38 with $10 million, you got to go find Robinhood-like stocks. You got to find Meta-like stocks. That way in Meta, you put in $10,000 and you wake up in 5 years and you have $30,000, $35,000. That's the kind of growth that I would want in appreciation for a young investor. So keep that in mind. Food for thought. When you're young, have an appetite for high appreciating stocks. You have time to recover if you have a bad year. Real estate investment trusts are for older dudes like me. And I don't even get I own one because they don't have great appreciation. 40% is not bad. And then you get 3% dividend. So maybe a combined year up to 55%. That's not good enough. I want 100%. I want to double my investment in 5 years. I want double. That's what I'm looking for. And REITs don't do that. They don't do that. So keep that in mind. This is a quality REIT, and it's in the right business. If you're 55, it'd be like, hey, good idea. It's going to give you some income. It's going to preserve your money, your capital, it's going to do well, I would think. But that's me. That's what I would put out there. And good luck with all your decisions. All right. So Coinbase, man, Coinbase opened nicely and then it faded. Ended up 4.5. I mean, the whole market just whipsawed and it sold off. The market was like angry. It was just like throwing lightning bolts on the stock market. Boom, 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 boom. And this one here, this is a good company. I like being a stockholder. Over the 1 year, it's flat. Over the 5 year, you actually lost money on your IPO. But this is where I bought. And it's all about buying at the right time. And I bought at the right time, and I'm sitting on good gains for Coinbase. These guys continue to grow. They are the number one player as a brokerage for cryptocurrencies. They're doing really well. I think the pullbacks are an opportunity. I own plenty of Coinbase. I don't want to own too much. It is a riskier asset. It's one of those assets that, it could be worth a lot, but it could also sell off very quickly, as it's proving to be. When we look at Coinbase, it's all about when you buy the stock. If you bought it at the right time, you're up 500%. So looking at companies that you believe in, which was the case with Coinbase, and then taking that nice, fun escalator ride up 200% since over the last 2 years. That's the kind of appreciation that I'm looking for. And Coinbase has achieved that. It has great volatility. It really cranked up around the election. Look at that. Went up 87% from November 1st through December 6th. Oh my gosh. Euphoric, irrational, stock selling off. That makes sense. That makes sense. So that's Coinbase. It's a winner for me. Lardog. Following up on PayPal. You think it's overvalued, huh? On PayPal. And you said it 30 times. So let's do the math together because I want to understand your point of view. So we've got free cash flow, 6.7 billion. 30 times would take this valuation up to 201 billion. Hopefully you're with me. 201 billion is way higher than 69 billion. So, yeah. So anyway, I just showed the math. Hopefully that makes sense. All right, cool. TSM continues to drop and may at some point be a good buy. I made a lot of money on TSM. I invested in TSM starting like in 2016, 2018, held it for some time, sold it, made really good money on TSM. And haven't owned it in a while. Sold probably around here. And then the stock kind of had a tough time for a while. But then, boy, look out. Stock market, pay attention. TSM, getting it done. Nice. So this is up 25%, but you can see this really big drop, 22%. I think TSM is priced a little too expensive. Am I following this stock? Let's see here. No, I don't have a valuation on TSM, but we can do it kind of on the fly. So I think they're a good strategic business. Now, they're growing really nice. They had a contracting year in FY23. Now they're growing really nice. They have good volumes, good demand. They did build, I think, a plant in Phoenix in the US. So that was a good move, 33%. So when we look at their free cash flow, and this is in the Taiwanese currency, so TWD. But I got a little shortcut here. When I go here, this website, Stock Analysis, will convert it to US dollars. So CapEx. So their free cash flow is $26.43 billion of cash. Oh man, these guys generate cash. What a beautiful thing. Now at their growth rate, I can multiply this times 30. We get to about 750 billion, and they're being priced at 800 billion. So they're getting there. They're just a little expensive, just a little bit expensive. When we look at their cash on the balance sheet, I think they do have a balance, and they have 41 billion. So they're fairly priced. Look at that. You multiply their cash flow times 30, you get to like 750. You add that 43 of cash that's on the balance sheet, you get near that $800 billion in market cap. So if we see their market cap come down to, let's say, 650 billion, this would be a really nice buy. Now, I always am concerned with TSM that China is going to want to take over Taiwan, and how would that change things? Now, it's kind of remote, but it's possible. And I don't know if that would screw things up for TSM. Probably not. The Chinese are smart enough to say, let them continue to operate. We're cool with that. But this is getting there. We could see this thing drop maybe to 650. Boom. Swoop in and take advantage of that. And maybe it'll get there because it's been dropping. It's been dropping quite quickly. Let's take a look at the 6 month. Man, look at this. It's been going sideways. Dropped 23%. Over the 1 month, down 13%. So it's dropping. It's dropping quickly. Can it drop down to 650 in market cap? Maybe. We'll see. Yeah. So, TSM, like anything semiconductor is really, it's expensive, it seems. Semiconductor has done so well for 2 years. Like it's never done that well, like really, really well. So the prices are really expensive. So we got to wait a while before the prices get nice and discounted. We got to go to where the market's giving us great discounts. I think healthcare is providing good discounts. Software is providing good discounts. Those are two places that I'm thinking are going to work for me in 2025. So, all right, everybody, it's been an awesome stream. And I wanted to stream because the market sold off so horribly. And everybody just keep your chin up and keep working at it, man. Keep trying to figure out how to make more money, how to get better as an investor. I really appreciate you guys asking all these stocks. We had 2, 4, 6, 8, 10, 12, 14, 16, 18. So we covered upwards of 20 stocks today. We flew through them. I follow valuations that are principally centered around free cash flow. Looking at free cash flow, the expected free cash flow of a business, trying to get today's present value of all those cash flows. That's the value of the business. And trying to see, is that business price too high or too low? And then making decisions after that. Other decisions that are qualitative, like, do I like the business? Do I understand the business? Do I have confidence in the business? Is this business so good they're dominant in their industry? All those things come into play. But it has to be grounded on a good value in the company based on free cash flows. So everybody, keep your head up, keep your chin up. If the market is angry again tomorrow and it screams at us, these big red numbers, just be focused. If you played football and you had a tough football coach or basketball coach or baseball coach, just remember, they're just trying to make you better. And the market screaming at us with these red numbers, they're just trying to get us better discounted stocks. Don't take it personal. I would love for these stocks to continue to tumble and come down in value. I'll swoop in and buy them. And we'll see how things play out. Thank you for tuning in. A couple people wanted to be part of the Discord. Reach out to me. I'll get you a Discord invite. Consider being a paid member. I know a couple paid members were on the stream. I really appreciate your support. It does mean a lot. And what's even better is the relationship that we have going and how we give each other our points of view. And hopefully that's making a difference in how you invest. It certainly makes a difference for me. And it's been a lot of fun. So consider being a paid member. There's a lot of perks to it. You can check that out. The details of the live stream will give you more information, or you can visit the YouTube channel. Everybody have a terrific night. Let's see what happens tomorrow. I'm sure people are going to be riveted on the first hour of trading tomorrow. I certainly will be paying attention. Take care, everyone. We'll see you.